You are listening to Investing Matters, brought to you in association with London South East. This is the show that provides informative, educational and entertaining content from the world of investing. We do not give advice, so please do your own research.
Hello and welcome to the Investing Matters podcast. My name is Peter Higgins and I'm here with the hugely talented Reg Hoare, Managing Director of MHP Communications. And Reg has been in the city, had a career in the city for over 35 years, investment banking, securities, previously with SG, Warburg, Nomura, and now is in financial PR. Welcome, Reg.
Hello, Peter. Great to be with you.
Great to be with you, sir. Now, I wanted to ask you this question to start with, right? Because we've spoken about this before. You're the son of a farmer. You go to Bristol University. You do politics. It's got lots of economics in there, and that's your first eye-opener to life in the city or what goes on in the city. Tell us about that. Because I like the fact you've had a nice traverse of a journey there.
Yeah, it actually there's also kind of that random element that, you know, you're at university in your last year and you've got no idea what you really want to do, you know, unless you're one of those people that's got a calling and you know you want to become a doctor, an accountant, a lawyer, you know, whatever it is. But for most of us, I seem to remember, you know, me and my contemporaries sort of slightly stumbling around going, you know, what does everybody do? You know, and in those days, of course, it was quite difficult to do research because there was no internet, nothing to go and Google. So, and there was a pretty useless careers department, to be frank, in those days. And there was something called the milk round, which I suspect still exists, you know, where certain employers would post job opportunities for graduates, you know, to fill up their graduate trainee schemes. And fortunately, Bristol was on that kind of network. And so there were a few things that, you know, one randomly applied for, including certain city type jobs. And in the end, that seemed to be the area that was getting most traction for me. And it was certainly an area of interest without really knowing what it was. I didn't have any kind of family history in the city, and eventually got offered a job in stockbroking and took it. You know, jumped in at the deep end in 1983. So
1983, so we're coming up, you know, to another big anniversary next year.
Another big anniversary indeed.
Yeah. Fantastic. So we're 40 years for you. That's absolutely phenomenal, Reg, you know, because we see so many people come into the city and go out of the city because of the stresses and strains of it.
Sure.
Now, so you had a bit of time at SG Warburg after stockbroking and Nomura. I want to talk to you about that particular phase very briefly. Some of the individuals you met, some of your learnings from that, because obviously it's, you know, you're in that time frame where it's very, very busy and lots going on. And, you know, 1987, Black Monday and all that sort of stuff going on. Lots of learning. So share us a little bit about some of your experiences, please.
Yeah, it was an amazing time, actually. I was quite lucky with the benefit of hindsight, sort of being in the city in that period, 83 to sort of 95. And actually the first thing that happened that was really interesting was the privatization program kicked off in, I think it was 84-ish. And we were involved in the British Telecom privatization initially. So that was a really interesting time. And then we, in 1986, had Big Bang, which completely changed the way that investment banking and stockbroking operated, and sort of resulted effectively in the kind of free-for-all that we have now, where anybody can own, you know, any type of financial institution, and you know, as long as they're regulated by the FCA, you know, they can choose what to do. Whereas before it was all highly regulated and controlled, and you could only be a stockbroker. You know, you couldn't do other things as well. You could only be a fund manager. And so on and so forth. So that was kind of a really interesting time of change. And the foreign ownership thing was the other big change that happened at that time. All the UK firms, you know, were UK owned. That was it. And suddenly it was opened up to competition. So that was a kind of time of great change. And then the crash, 87, that was pretty extraordinary. You know, we had this bizarre weekend where we had the hurricane overnight on the Sunday night. We got up to complete chaos on the Monday morning trying to get into work. Wall Street had a dive on the Friday night, so we kind of knew what was going to happen on Monday morning. So it was like the apocalypse, trees all over the place, cars crushed, no trains. I mean, just absolute carnage. And there were a couple of, by then I was at Wahlberg's, and there were a couple of privatizations actually ongoing at the time. We were in the middle of doing the BP privatization. It wasn't like the original one. It was a sort of secondary one where they were selling more stock. And obviously that made it extremely difficult. And there were a couple of rights issues which were underway at the time as well, which we were helping with, advise with, and so on. Ladbrokes and Scottish and Newcastle. The latter, of course, no longer exists. It's subsumed into, I'm not quite sure where it sits now. But those two rights issues were underwater, as you could imagine, because of the crash. So that was kind of interesting, navigating our way through that. And actually, the subsequent 5 years after that was a period of a lot of activity, M&A and fundraisings and privatizations. And then, of course, there was another crisis in '92 with the European exchange rate mechanism, when we had a kind of false start in the UK of going into that sort of early version of the euro. And very fortunately, in my view, it was a complete disaster, and it put us off going into it. And actually that experience, I think, stood us in good stead in terms of, retaining the pound and not getting stuck in the euro. So that was kind of a cataclysmic moment in '92. So yeah, really interesting times. And, the learnings as much as anything were around the technical side of it, during that period, just kind of understanding, all the, what all the KPIs were and all the technical stuff and, all the crazy sort of goings on, and beginning to get a feel for the way that markets behave, the way that they're very driven by psychology, frankly. And, they're always anticipating future events rather than looking back at the past. And how they can get very overbought and very oversold, which then leads to fairly sort of precipitous moves when, things either go wrong or right. So, yeah, really interesting time of learning, and it stood me in incredibly good stead, for the latter part of my career.
Excellent. I love that full response. Thank you very much. We're going to cover some of those points a bit later on as well. I wanted to ask you, with regards to all of that learning, what sort of insights you can give to our current new investors who are seeing almost, I don't want to be disrespectful to them, but seeing smaller fluctuations of what's going on and what you experienced between 84 and now, how they can actually manage their psychology. Yeah. Because a lot of them are panicking and, I've gone all cash, I'm out of the market, I'm not coming back for a little while, I'm watching them on the sidelines. What would you say to them in the sense of, being calm?
Yeah, I think that's a very good point. And actually, I think that what I learned was that on the days when the market's kind of down, 3%, 5%, whatever it is, you're almost better to pull back at that point and just not do anything. It's too late to react. And usually if you react, on the day or two immediately after one of these events, usually you'll then regret, you'll sell the wrong things. If you try and buy something, it'll probably be wrong as well. So you usually just better to kind of step back and just remove yourself from it. But I do think it's wrong to then sit on the sidelines, for the next, whatever it might be, 3, 6 months, a year, whatever. I think you do need to keep an eye on things and then work out what your kind of strategy is thereafter. And what's always kind of worked for me is to review things, within a few weeks. And what you usually find is that there's been quite a significant rotation during a period of crisis. So not everything goes down, by the same percentage. Obviously, the market goes down, for the sake of argument, 10%. The reality is that by sector, there'll be a huge range of ups and downs. And the key to it for me is to then review what that's done to your portfolio, And you'll soon realize, you'll think, well, actually, some of those things haven't done too badly. Those have done badly. And then you can work out whether you think things have been oversold and actually whether they're cheap and you ought to buy some more, whether the things that are held up may be not wholly justified, and actually whether you should sell some of the things that held up to reinvest in the things that have gone down, if the investment case is still valid. And I think we've seen a classic period of that, over the last couple of months, where we've seen a strong outperformance of natural resources and energy type stocks. We've seen retail, for example, absolutely smashed. So, it's a good opportunity, in effect, to take stock and say, right, do I agree with that? Am I going to adjust my portfolio accordingly? So I think it's that combination of, initial patience, sit on the sidelines, don't take decisions which you might regret later, but then really reviewing it quite scientifically, in the weeks that go on thereafter as the market evolves, and take a view as to, whether you need to make some changes. And of course, I might add, I think it's always easier, in my opinion, from my experience, if you've got quite a diversified portfolio in the first place and you're not overly exposed to a very sort of concentrated group of stocks. If you've only got 10 stocks, that's going to limit your maneuverability. But if you've got 20, 30, 40, 50 with smaller holdings, you're going to find that you've got a bit more flexibility around, what you then do thereafter.
Thank you. Great response. Great reply there. Thank you very much. Now, with regards to what you've said there, I wanted to ask you about I put a huge, part of my thinking around the psychology of investing. I wanted to ask you, Reg, personally, as a ISA investor and a SIP investor, how much importance do you put on psychology and keeping yourself together and not going, running out of the house onto the golf course, whacking some balls because the market's enraged?
No, I think that's hugely important. And, the reality is that unless you are a full-time investor who's spending the whole day, looking at your investments and doing whatever you do, none of us have really got time, if we have a day job, as I do, to actually be able to kind of, be in control of events. And therefore, psychologically, it's really important to try and just, step back, be calm, not overreact, etc. And I think it's very difficult, clearly, though, because we all get sucked in by the emotion. And there's no doubt there's a lot of emotional attachment to certain stocks, certain sectors, which we're convinced that, this is the right thing. And it's very difficult to pull oneself away from that. And it's also very difficult not to get sucked into situations. And we read a lot of chit chat on Twitter and the bulletin boards about certain fashionable stocks, which certain people have made lots of money in, and we get sucked into that. And actually, maybe we don't know enough about it, or, we're a bit late to the party, and then we make the error. And unfortunately, I think even after 40 years, or close to 40 years of investing, the reality is one still keeps making some of those same errors that one made, at the beginning, in terms of the emotional attachment and so on, and being sucked into things. And it's really, really difficult to wean yourself off it. And actually, the best way to wean yourself off it is actually have a small exposure. So if it is something you're thinking, is this against my better judgment? Am I being sucked in? Then only go in small. Maybe that's probably arguably the way I've rationalized it. I know that's a psychological weakness. So therefore, if I have a small exposure, I know that my downside's limited.
I think that's a sensible approach.
Yeah.
I think that's a really good way of looking at it, in the sense of, the larger the exposure, the greater your psychological flaw is. And then once it starts to go the wrong way, you're immediately flapping because you're overexposed.
You're overexposed, exactly. And if you never go, let's say for the sake of argument, you never go more than 5%, and maybe on average, most of your holdings are, say, 2 or 3%, then even if you're emotionally attached to it, you're actually not, your emotional attachment isn't that great, because it is only 2 or 3%. And we all know that you can make that up relatively quickly. hopefully if something else goes well. So that's always been my approach. And I think the other way, is you get your initial investment, put a toe in the water, don't bet the whole house, in one hit. So I'm very much a buy and build, in terms of my holdings. And as I kind of get to know, the business better, as I get to know the investment trust better, actually you then understand the share price better, because, share prices they kind of have their own way, and again, that's partly because of the overarching psychology of the market. It might also be merely down to liquidity. It could be down to all sorts of, other reasons, like how much research there is on the stock, etc. Loads of reasons why share prices might be volatile. And actually, if you go in small to start with and then drip in more money as you get more confidence in the story and more confidence in your own ability to manage the holding, then actually that's quite a good strategy, in my opinion. Again, that's sort of worked well for me over the years. Not always perfectly, obviously, but and the risk of that is you then have the catch the falling knife syndrome. Obviously, if you're dripping in and share price keeps going down, then that is always a risk. But actually, again, at that point, you can reassess, your analysis. Is this story still right? Is it still ultimately going to pay off? Has the market in the short term, got it wrong because the market's got into this, very negative cycle? So that's kind of the way I think about it and rationalize it as I go along, with my shareholders.
Excellent. So with regards to you rationalizing it, there are occasions where, as you said, you dripping in the market, and it happens to all of us. We've done our research. We're very confident about the company, the CEO, the leader, and the niche that they're in. And the market, you touched on falling knives, is dripping and going down as you're still dripping in. When do you go, actually, Reg, you might be wrong on this one?
Yeah. The answer to that is, I guess, when it gets to that point where it just seems that like there's nothing can stop it. The good news is ignored, essentially. And maybe a good example of that is Boohoo, where yes, there've been some forecast cuts and so on and so forth, but broadly speaking, since, I don't know, halfway through last year, it looks like the company's been doing the right things, in terms of the corporate governance and the ESG and the other stuff and sorting out its supply chain and et cetera, et cetera, et cetera. But the share price has just kept on going down. And in that situation where I had gone into it, and initially I'd had some success with it, I then thought, okay, I'm pulling back. I'm just going to sit on the sidelines. I'm not going to do anything because this share price has got a mind of its own. But I'm still convinced about the long-term argument that this is an attractive growth story, quality management. Everybody else is going bust, which means it's going to gain market share, blah, 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 all the bull arguments for that stock. But there's a point at which you can't kind of fight the falling market. So at that point, you just have to step back and go, okay, I'm not touching it until it's found a level. And maybe this is where the charts can be used. I'm not a chartist, but there's no doubt there's a point at which, when you start to see that share price, getting into the U of the bath or whatever the expression might be, that's the point you think, okay, this has found a level. What's the news flow like? Maybe it's time to, start looking at it again from the point of view of buying it, or indeed maybe at that point you think, okay, I capitulate, I'm going to sell because I don't think it's ever going to get back. But coming back to my point about position sizing, if you only had, let's say you started with 2% or 3%, and the thing's halved, you've only got 1.5% in it. Actually, what's the point selling it? At that point, it doesn't make any difference really. That goes from 1.5, or let's say it's 1%. If it goes to 0.5%, it's not actually making a great deal of difference to your portfolio performance. So actually, there's a lot of those kind of stale bull situations where I just sit and hold and I wait for some catalyst, and there'll always be a catalyst. Again, one of the lessons of the stock market is there's always a catalyst at some point in a stock. And you might have to wait 3 years, 5 years, but hopefully we're long-term investors. So actually we can afford to sit and wait on those small holdings that have we can almost shift them in a corner, park them if we've got only 0.5% or 1% in it, and we can just wait and see what happens. And ultimately, it's amazing how often something then happens. You know, a takeover bid, a change of management, you know, a change of fortune, you know, whatever it is.
Yeah, because a lot of what happens in the market is sentiment driven, which is
Totally.
why, you know, the technical people, the charters actually use, you were touching on what the bowls on the basis, but the 200-day moving average is what, you know, once it starts to peak back up above that, that's usually a good sign that it may have some further running to go. And then sometimes it comes out with some good news, like you say, or a catalyst. So yeah, it's a very interesting stock, Boohoo. The sentiment was so high at one stage that they could do anything and the market would just do the share price up. And now
it's been the other way.
Absolute opposite. So and that's the psychology of markets that people don't understand.
Absolutely. It's the psychology, the sentiment. And my father, very sadly, was very bipolar. And that experience growing up with a bipolar father, sort of through my teenage years and early 20s, taught me that actually, unfortunately, the stock market is very bipolar. And it goes massively, the sentiment just goes like that. You know, it goes risk on, then suddenly it's risk off. You know, it goes, you know, overbought, oversold. We talk about this thing, climbing the wall of worry. You know, so it'll do this climbing the wall of worry thing. And then eventually, once it's climbed the wall of worry, you think, hang on, well, what are we waiting for now? And actually, quite often, that's the point at which the market rallies. And we've sort of seen the beginnings of that actually in the last week or two, where, you know, all the bad news is in front of us. I mean, it's all there. You know, what else can happen? So, you know, so I think that's the psychology, the sentiment, the whole thing about the stock market is just, you know, extraordinary and bizarre. And part of our learning is just understanding that and just saying that's what it's like. So we just have to live with that and work with it.
Indeed. I mean, we appear, as you said, that the last few weeks or so, the market seems to have dealt with all of the worries, all of the stresses. But I'll ask you this because, you know, we've experienced, and you've experienced it in the near 40 years, lots of times when we've been in a bear market, we've had significant bear market rallies, only for it to go subsequently lower. What do you say to investors that are new to the game, that are listening to this and say, actually, I'd be mindful of these, or I wouldn't, you know, I would say, this is what to look for, because this rally might actually have some further to go, and we could be coming into a bull run.
I think one's always got to be mindful of that, you know, those spikes in the chart, and the fact you get the pullbacks, the drawdowns, then you might get another rally, and so on and so forth. And what I always look at, and I think again history bears this out, is that rotation thing I mentioned tends to happen during those spike periods of the rally and then the pullback again. You get more of this rotation thing going on between sectors. So, you know, we've seen the you know, the popularity of energy and you know, oil and gas and natural resources and so on and so forth. You know, suddenly retail's consumers out of fashion. Everybody's talking about value, not growth. But actually, ultimately, if the rotation goes too far, you know, one way or the other, suddenly actually the growth stocks become to look like value stocks. And at that point, you go, well, hang on.
That's happening now.
It's happening now. You look at a stock that's growing at, you know, 10, 15, 20% per annum. And you think, hang on, it's on a, you know, a low double-digit PE. And it's yielding 3 or 4%. You know, whereas before we'd all go, oh, it's on 20-something times and it yields 1. It's quite expensive. And people are still buying it, despite it's expensive. And so I think you need to look for those opportunities where that rotation has flipped stocks like on their heads, and actually suddenly it's really good value. And actually it might be the moment when you get those spikes and drawdowns or whatever, again, to look at the things that have outperformed, you know, maybe take some profits there, take the top off holdings. You know, these might be long-term holdings. You just take the top off and put that money to work, you know, in something that's got some recovery potential. So that's kind of the way I look at it. And that's what I've been doing, essentially since this crisis, since the war started in Ukraine, that's broadly what I've been doing, is top slicing the things that have outperformed during that period and buying back into things actually that I top sliced last year. Suddenly are lower than, a 20% lower than the price I top sliced at. So you're just always doing.
For me, on that nuance, could you please expand on the top slicing bit? Because a lot of people don't understand it.
Right.
And I think what happens is that there's a good friend of mine that does it a lot. And then people put up charts to say, oh, from January 2021 to April of 2022, this share price has gone nowhere. But the person that's gone up 15% and 20% has top sliced it a little bit there, bought it back again, it's gone up again, top sliced it again. They do that 3 or 4 times over the course of 2 years. They've got 100% return.
Totally. That's always been my approach to investing. So I think it's easier to do where you've got some really long-term holdings in your portfolio, which are, let's say, you might have a group of them, which are your biggest holdings. And quite often it's easier to do in investment trusts than it is in, conventional industrial companies, because the investment trusts will follow the market more, whereas the companies may obviously have their own dynamics, which means the share price might not, might be a bit out of kilter with what the market's doing. And so for a good example might be something like Herald Investment Trust, which I've owned for, as long as I've had a SIP. And it's absolutely a long-term keeper fund, but it's done incredibly well over the years on the back of the boom in tech. And because the manager has been a very clever manager of the investment trust, it's had a lot of takeovers of the businesses within the portfolio. And over time, the share price kept on going up and up and up and up and up. And eventually the position size got a bit too big for me. It was nearer 5% and 3%, which is kind of the point at which I begin to think about top slicing. So I top slice. And my mantra is, if it goes up another 15% after my first top slice, I'll do another top slice. And my top slice percentage is usually actually pretty modest. So I might only top. So let's say I've got a holding. It's probably easier to do it in numerical amounts. If I've got a £20,000 shareholding, I'll only top slice 5 or 10% of that shareholding. So I might only sell 1,000 or 2,000 quid's worth. So it's very much at the margin that I'm doing this. And then if it goes up another 15%, I'll sell a few more. Goes up another 15%, I'll sell a few more. Goes up another 15%, I'll sell a few more. Now, you might argue I'm missing out because I'm top slicing all the time, but the amount of times I've then been able to buy back has been quite extraordinary. I mean, it surprised me. I've gone, seriously? I'm buying these back again? Okay, great. And that takes a bit of patience. But at the moment, I've been able to buy Herald back. I sold some at like 22 quid, 24 quid last year. I've just been buying them back at 17 and 18. And it's taken a market correction to enable me to do that. But I think it's absolutely the right thing to do. So that's my top slicing technique. And there may be others that would do it slightly differently. They might top slice a bigger amount. But for me, it's like top slice no more than 10% of a shareholding, and then wait for the opportunity to buy it back. And as I say, it's amazing how often it comes around again.
I love that strategy. It's brilliant, because the beauty of that is that you're doubly compounding your long-term returns, because you're able to buy. Essentially, people always say, buy the dips. But when the dips arrive, they're shy away from, it could go lower. You've got to go back in.
You've got to go back in. You've got to go back in on the dip. Absolutely. You've got to be disciplined about that. And I think you've obviously, the example of Herald, you've obviously also got to just look at the discount to NAV and see where that still is. And if that's still, and at the moment it's very attractive, it's double digit. So you think, okay, that's absolutely the right thing to do. It's a no-brainer to do that.
Excellent. Now, I want to change it up just slightly, and then we're going to talk about the nuances of your role. So expand on your role as Managing Director of MHP Communications, and what you do across the industry, because it's not just stocks and shares. You've worked with some of the investment funds and investment trusts as well. So people get an understanding of that fully.
Yeah. So we've got quite a sort of wide range of clients across both, stock market quoted businesses, which could be in any sector. And also we do financial services PR. So we do PR for financial institutions, which is more about PRing their products, their services, etc. And that could be any type of financial institution, from an investment bank to an insurance business, to a fund manager, to an insolvency practitioner, to a city law firm, etc., etc. For the quoted companies, we look after about 65-ish quoted companies, all shapes and sizes, from sort of smaller end of AIM through to the big end of AIM, then up to the fully listed FTSE 250, FTSE 100. So we're unusual in that we do the kind of full range of shapes and sizes of companies. We like to think they're at the quality end, and I think there's good evidence that they are. They tend to be sort of profitable, growing businesses that are ambitious and active with M&A, and then obviously we help them with their whole kind of life cycle as a quoted company. So we'll help companies with the IPOs, help communicate those. Then we're doing results. And then obviously the day-to-day stuff, there might be board changes, investments, restructurings, you name it, we're up to it. And then obviously there may be M&A, where clients are being bid for. And some good examples recently have been Cobham a couple of years ago. We're on the Ultra ticket at the moment, which is an interesting situation. And then we've got all sorts of other, what we might call sort of crisis and issues management. So a good example where we're helping at the moment is a client of mine, Nanoco, which is kind of quite a popular retail stock, where they've got this amazing litigation ongoing against Samsung. So we've been helping them with that for the last couple of years, in terms of the messaging, announcing progress in terms of the litigation activity, and as we go along, also getting some press coverage as the story develops. So there's a wide range of activity that we get into.
Plenty to keep you busy. Right.
Oh yeah. It does. It can be quite cyclical. I've got a client base where fortunately not all of them are doing stuff at the same time. So I've got a nice range of financial year ends, which means my results season is quite nicely sort of, even through the year. And then fortunately, not all of them, are doing M&A or having a crisis at the same time. But it's amazing how sometimes you do get extraordinary periods of time, where suddenly, you've got a client being bid for, you've got a couple of crises, trading, profits warming, and then another client rings up and says, oh, we're having a change of CEO. And you think, how can this all happen, like within a week? But that's part of the excitement and the interest in keeping it sort of fresh and new. And there's always something new, even after the period of time I've been in the market, never ceases to amaze me how you get like a new situation that you've never seen before. And you think, oh my God, okay, that's new. Okay, well, this is what this is how we should deal with it. This is how we should communicate it. These are, the messages we should go out with.
So talking about different things and things being new that you think, crikey, I've never seen that before. What would you do or experience in the past where you've got a situation now where you've got the likes of Elon Musk, right? Yeah. You discover that you've got a mandate for this brilliant company, but later on down the line, you've discovered that you've got an Elon Musk-esque CEO. How do you, as a team, manage that? Or do you think, give them a couple of months and we're going to have to get them off the books? How do you manage that sort of character?
A very good question. And I think it's fair to say I've probably not attracted that many of those characters to my client list over the year. Maybe I'm too sensible. But yeah, you sort of slightly have to just let the ego get on with it. And inevitably, I think the advisors find over time in those situations that they just kind of need to step back and let him or her just get on with whatever it is that they're going to get on with. And obviously in the sidelines, you might be advising them to say, actually, I really wouldn't do that. And maybe I'd do it this way. But you often find actually they're not very good at taking advice, those types of characters. So therefore you just kind of plug on. And then eventually, usually what happens in my experience is either the situation completely blows up and you find that, it's a busted flush or whatever. And quite often the baby gets thrown out with the bathwater. So quite often, the early victim of a crisis is the financial PR company, because somehow we didn't, polish the
Wow.
Yeah,
I didn't know that.
Yeah, it's
you could get the blame first.
Yeah, we get the, you suddenly find that it's like, okay, we need to fire somebody. Usually what happens is they fire people internally first. That's part of the mechanism. And then eventually they start firing advisors, even though it's not your fault, because you can't, as I say, polish the
because you didn't manage the narrative. You should have managed the narrative better then.
That's their argument. That's obviously the board's conclusion, but it's usually a false conclusion, and usually actually then leads to further problems, because obviously they're thrashing around trying to find somebody to blame. Yeah, and actually the person they should be blaming is the egotistical chief executive. So yeah, that's a situation we've often, over the years I found is quite, it's quite irritating, as you can imagine.
Very, very interesting.
Yeah, they're shooting the messenger, as they say.
Yes, absolutely. Continuing on the communication side, the largest growth over the past few years and money being spent on is on ESG at the moment, regarding lots of different investments and funds and so on and so forth.
Yeah.
How much work are you doing, and how much work is being done? And does it benefit some of these investment companies and companies regarding ESG communication at the moment? Have they benefited from it?
That's a very good question. I think broadly, yes. I mean, I think a lot of it is compliance. A lot of it is saying, there is this trend, we need to be cognizant of it. What are we doing about it? Let's communicate it. And quite often you find actually that companies are doing quite a lot already without kind of really, writing it down or sort of collating it. And when you actually quiz them, they go, yeah, well, we've always done that, in that business. And we've always had people that do this here. And particularly around the S bit, actually, the social bit really interests me, because the environmental bit is, it's kind of numbers and statistics, isn't it? And it's saying, when you reduce emissions by X, so we invest, Y in a new bit of, whatever it is, technology or something. The S bit is the sort of, is the softer, less easily measurable bit, i.e. the social side of it, and particularly the culture angle. So talking to clients, I found it really fascinating over the last year or two, talking to them about their internal culture, and where they, to me, looks like they've got a really strong internal culture. I've said, well, you need to emphasize this, because that's the glue that holds your business together. That's the thing that makes your staff loyal. That's the thing that actually your customers, sort of understand. Maybe they don't, it's not articulated, but it's there. And that's been noticeable, I think, during lockdown and working from home and so on and so forth. And one or two clients have actually been able to articulate that quite well as a result of the conversations we've had, and saying that you need to talk more about this. And so they've been able to articulate it quite well in their statements. So that's been important, particularly for people businesses. I mean, obviously, because a lot of the challenge for companies is, well, we don't have factories, we don't have emissions, okay, we've got an office, but not really, we don't make anything physical, if we're a software company, we're not actually making anything that, has an impact. So that, again, that social thing, the culture thing becomes much more important for those types of companies to talk about the S bit, and again, last but not least, the governance bit, again, it's very driven by fact. It is what it is. you're either complying with it or you're not. There isn't really much of a nuance, unfortunately, around it. So yes, we spent a lot of time advising clients on it, and I think broadly it's beneficial that they do. And anything that kind of gets the client thinking about it, I think is always a good thing, because actually sometimes they're so wrapped up in their businesses in the day-to-day, they don't have time to think about some of the other stuff. So I think it's been quite a good discipline to get the internal debate going.
Excellent. No, that's great. Thank you very much for that reply. Now, Reg, regarding your own personal investing, how has that nuance of ESG been applied to your own portfolio, or hasn't it?
It hasn't, to be frank. I'm kind of, I'm, obviously we're all, concerned about what's going on with climate change and what have you, but I feel that the particularly quoted companies are so much under the spotlight that, in my experience, they evolve quickly and adapt quickly to these situations, just as they do to criticism about their business models or their strategy or their leadership or whatever it is. So I'm sitting there going, well, I know my clients are all doing the right things, at their own pace. So therefore, the things I invest in, I sort of take the same view. They'll be doing the right things, slowly but surely. So it's not a measure which I'm adding into the pot, shall we say. So I don't have a problem investing in, defence, tobacco, etc., oil and gas. If I think it's a cheap sector, I'll go for it.
And that's the same with myself as well. Yeah. So I completely agree with you on that front. I wanted to ask you, with regards to your portfolio, you mentioned earlier diversification. You've got your ISA and your SIP, and you've got it across investment companies, let's say investment companies, funds and trusts, and also small caps and mid caps. Can we talk about some of your selections, your strategy of selection? And then you spoke about usually having a smaller position and working up to 5 and then top slicing. Yeah. How do you filter, Reg, which investment companies you select, and also the stocks, so our new listeners can get a grasp of, actually, I never thought about how I go about selecting my stocks, other than what's on the bulletin board and on social media.
Sure. So I think, I've sort of analysed it recently, actually, funnily enough, and slightly prompted by an article I read about the Yale Endowment Fund, which is the Yale University in the States, and how they ran their money over the last 30 or 40 years, actually 50 years or so. And I realised I was I seemed to be by default doing broadly what they were doing, which is that taking a view of assets sort of across the piece and how we can access them through the stock market. And it occurred to me that actually ultimately what we're trying to do is grow our portfolios, the value of our portfolios. And ultimately that's linked to, the underlying growth of the businesses and the income that they are, their profits, which they can turn into dividends. And that's what kind of drives the long-term value. And the sectors that seem to do that best are actually things like small companies, because they grow more quickly by definition, and the kind of faster growing, sexier sectors, for want of a better expression. Ultimately over the longer term, things like technology and healthcare are always going to grow more quickly than traditional kind of engineering businesses. And then alternatives, and particularly private equity and venture capital, are always going to grow faster than conventional listed companies, because broadly they're growth capital. That's what they're, the businesses they're investing in are by definition fast growing businesses. So I've ended up with, therefore, when I've chosen investment companies, I very much focused in on those areas. I've gone, right, I'm going to be overweight smaller companies, I'm going to be overweight private equity, I'm going to be overweight venture capital, I'm going to be overweight sort of technology, healthcare type areas. So I've been very much skewed to that. And then in the smaller companies I invest in, actually I'm much less sector based. I'm much more stock specific, where either I know a stock for whatever reason, or I've been attracted to it. Occasionally I've invested quite successfully in former clients, where I know the business. I've had a bit of a bent towards technology, and particularly to software, because I found that's been an area which is, again, it's been fast growing, but also it's attracted a lot of bid activity over the years, a lot of M&A, and I've had great success with M&A in that sector. So that's kind of broadly how I kind of have seen it. So I've now got a portfolio which is, very much skewed to equities, and it's very much skewed to, smaller, faster growing areas of the economy, which I think are going to, provide better returns over the longer term.
Thank you for that reply. Now, you touched earlier about the diversification and size of, and you did question smaller portfolios and concentrated portfolios. So I'm assuming you've got a larger breadth of investment companies. And
correct.
So what's your view of what is a better strategy? Obviously, you're diversified, but some people are saying actually it's better to be concentrated.
So what I do is my concentration comes in the sector, if that makes sense. So let's take the example of smaller companies. So in smaller companies, I've actually got, this is investment companies, smaller company investment trusts. So I've actually got 4 or 5 of them. So if you tot up the total amount in smaller company investment trusts, I've actually got more like, I'm just trying to do the maths in my head. I've probably got nearer 10% of my portfolio in smaller company investment trusts, but actually I hold 4 or 5 of them. And the reason I hold 4 or 5 is to give the diversification and reduce the concentration risk, because the individual managers, their performance varies. They're not all performing exactly the same way. Secondly, their portfolios are subtly different. So JP Morgan Smaller Companies Investment Trust, which I've held forever, in reality is more of a mid-cap fund. It's mostly investing in larger AIM companies, £1 billion market cap upwards, and things that are just moving into the bottom end of the FTSE 250. Whereas I hold the mini Miton small cap and the River and Mercantile micro cap investment trusts, both of which are very much focused at the lower end, the sub 100 million market caps. And of course, that means they're really completely different from the JP Morgan one. And they behave differently. And then the other interesting thing is that the River and Mercantile one has a policy where if the market cap goes on over 100 million, because the performance is good, they actually return capital to shareholders. And that means that the manager's always really focused. And it means effectively they're always taking profits, but they're always top slicing. Effectively.
Always top slicing, exactly.
Yeah. And then obviously as has happened now, the shares have fallen back, they can actually issue new shares to increase the size of the fund again, or just wait for the performance to come back again and hey presto. So, that's a really interesting vehicle. So you can get the concentration in a sector, but at the same time get the diversification through buying these slightly different vehicles with a slightly different approach. And I do exactly the same in my private equity investment company holdings, my venture capital ones, and technology and whatever. So I've got that sort of diversification, basically, but at the same time, the concentration.
Reg, you're a very smart, very shrewd individual. I'm going to have to I've been clocking all those tips, by the way. Thank you very much.
It was working very well up until Putin made life very difficult.
And it will work again going forward.
Exactly.
I have no worry on that front.
Every confidence that it's going to do that. Yeah.
Right. Now, I'm conscious of the time, so I'm going to ask you last couple of questions. You took some time out going back to 2001, and you bought and invested in I think that's where you are now, in Andalusia, in Spain. Yeah. You made a major investment in Spain.
Yeah.
And you finished it off, and now you're enjoying the pleasure of it. Now, the diversification is that this is actually a property. Yeah. Now, you've been in there and built it, finished it 20 odd years, and you've got a huge passion now for everything Spanish.
Yeah.
And I'm still waiting for my invite. So, so tell us about that and about having the assets. Obviously you've got places elsewhere in the UK, but you've got a fantastic property. And some people say, oh, no, I'm never going to property because I don't understand it. And the tax this and the tax that and overseas property. Explain that nuance. I think it's a fantastic thing to have as well.
Yeah.
And it's about reaping the reward of your investing as well.
Yeah. And it's sort of, when I first did it, it wasn't, essentially I want to diversify my portfolio, property portfolio, which actually was only one in the UK. And it wasn't, I want to diversify my currency. But then when I thought about doing it, if you sort of mean, initially it was hard going, I love Spain. I found this amazing place completely by accident. I'd be crazy not to go for it. Then when I thought about it up here, I was like, actually, it might have some benefits in terms of currency diversification, market diversification, albeit the Spanish market and the Spanish holiday coastal market is mad. I mean, it has talk about, a crazy wild swings. So then I had to go, hang on a minute, at what point of the cycle am I in? And actually I did have that thought. And of course, when I bought the land, it was kind of in an early upswing post there was a bit of a, going back to that time, post the .com crash, there'd been a bit of a market sell-off. So actually property was on an upswing. So actually the timing was quite good. And then, the euro actually has been fantastic because the euro has been ridiculously strong and the pound's been very weak. So it's worked out as a very good currency play. And also when I started building, which was actually a number of years after I bought the land, when I started building in 2010, again, I had to get the old brain going and go, okay, is this the right time to build? And one's heart at the time was going, no, we've just had a crash, financial crisis. Don't do it. You're mad. And then I thought, no, it's got to be the right time because building costs are low. Interest rates are going one way down, and it's got to be the right time to do it. So, and again, that's been the right decision as it turned out, because I've had incredibly low interest rates and I've built it quite good value. So it's been an exciting, fun journey. The downsides are it's a hassle. You've got to have tax returns and down in Spain, and Brexit's made that slightly more difficult. And, so there are hassle factors, and I have to rent it out so it pays for itself. And there's hassle around that. And owning two homes, there's always things going wrong that need fixing. So there are some downsides, but I get a huge amount of pleasure from it. And long may that last.
Brilliant. Now, my final question is an easy one. I want you to share this one with our listeners. Reg, have you learned some Spanish?
Well, I did O-level and A-level Spanish, actually, and that was part of the reason, along with going there on family holidays when I was a kid, for getting into Spain generally. And I've learnt a little bit. It sort of gets me by, but it's not very good, to be frank. I'm not fluent. And the downside in the Andalusia, it's like going to the Outer Hebrides. I mean, they have a very strong regional accent. So when you try to speak your O-level Spanish from 40 years ago, it's like, oh, dearie me. Yeah, but anyway, it's fun.
I'm sure they appreciate you trying, though, Reg.
Yeah, you hope so. You hope so. When they whisper under their breath, they have one or two rude phrases for foreigners, which now and again you think, I wonder what they're saying to each other when your back's turned.
Brilliant.
Yeah.
Reg, we could go on for another hour, I'm sure, but it's been an absolute delight to have you on here. Thank you for sharing those investment strategies with me and those insights.
Pleasure.
And we will have to speak again. I look forward to seeing you again very soon, face to face, when you're in London. All right. Thank you ever so much for sharing your insights with our Investing Matters
Cheers, Peter.
Listeners. Take care and God bless them.
Thank you.